The market is a fickle beast. It ebbs and flows with a rhythm that can be both mesmerizing and terrifying. For those who have spent any time investing, this is a well-known fact. The stock market can be a place of great opportunity, but also of significant risk. Understanding this duality is crucial for anyone looking to build a sustainable investment strategy. It can be exhilaratingly bullish one moment, with stocks soaring to new heights and investors celebrating their gains. During these times it feels like the sky's the limit, and the optimism is palpable. Everyone seems to be making money, and the future looks incredibly bright. And crushingly bearish the next. The market can turn on a dime, sending stocks plummeting and leaving investors in a state of panic. The same market that once seemed so promising can suddenly feel like a minefield, with every step fraught with danger. These downturns can be devastating, wiping out gains and testing the resolve of even the most experienced investors. As investors, we must be prepared for these inevitable shifts, these market corrections that can shake even the most seasoned portfolio. It's not enough to simply ride the highs and hope to avoid the lows. We need a strategy that can handle both extremes, a plan that takes into account the full spectrum of market behavior. This is where careful analysis and thoughtful planning come into play. That's where the all-weather strategy comes in. This approach, developed by Bridgewater Associates founder Ray Dalio, is designed to provide stability and growth regardless of market conditions. Dalio's insights into economic cycles and market behavior have led to the creation of a strategy that aims to protect and grow investments through all phases of the market. Developed by Bridgewater Associates founder Ray Dalio, this approach is designed to withstand any market condition, like a sturdy ship navigating a stormy sea. Just as a well-built ship can weather the fiercest storms, the all-weather portfolio is constructed to endure the market's most volatile periods. This resilience is achieved through a diversified mix of assets that balance risk and reward. The all-weather strategy is not about chasing returns in a bull market or hiding in fear during a downturn. Instead, it focuses on creating a balanced portfolio that can perform well in various economic environments. This means including a mix of asset classes such as stocks, bonds, commodities, and other investments that can provide stability and growth over the long term. It's about building a portfolio that can thrive in any environment. By diversifying across different asset classes, the all-weather strategy aims to reduce risk and enhance returns. This approach recognizes that no one can predict the future with certainty, so it prepares for a range of possible scenarios. This preparation is key to maintaining confidence and stability in the face of market fluctuations. This approach prioritizes balance and resilience over risky bets and short-term gains. It seeks to create a steady path to financial growth, avoiding the pitfalls of trying to time the market or chase the latest trends. By focusing on long-term stability, the all-weather strategy helps investors stay the course, even when the market becomes unpredictable. By accepting that we cannot predict the market's every move, we can instead prepare for its inherent unpredictability. This acceptance is liberating, allowing investors to focus on what they can control, their own strategy and behavior. The all-weather portfolio is built on the understanding that markets will always have ups and downs, but a well-constructed portfolio can navigate these changes effectively. This strategy empowers investors to weather the storms and emerge stronger on the other side. By building a resilient and balanced portfolio, investors can face market volatility with confidence, knowing that their investments are designed to withstand the test of time. The all-weather portfolio is not just a strategy, it's a philosophy of investing that prioritizes long-term success over short-term gains. At the heart of the all-weather strategy lies the principle of diversification, a concept that has been the cornerstone of successful investing for decades. Diversification is not just about spreading your investments across different assets, it's about strategically selecting a mix of investments that can weather various market conditions. This approach aims to balance risk and reward by allocating investments among various financial instruments, industries, and other categories. But not just any diversification. It's about intelligent diversification, where each asset class plays a specific role in your portfolio. The idea is to create a synergy where the whole is greater than the sum of its parts. This means understanding the unique characteristics and behaviors of each asset class and how they interact with one another. The key is to hold a mix of 15 uncorrelated assets or asset classes. Uncorrelated assets are those that do not move in tandem with each other. When one asset class is performing poorly, another might be doing well, thereby balancing the overall performance of your portfolio. This mix can include a variety of investments such as stocks, bonds, real estate, commodities, and more. This means choosing investments that don't typically move in the same direction in response to market events. For instance, during an economic downturn, while stocks might plummet, bonds could potentially rise as they are often seen as a safer investment. This inverse relationship helps in cushioning the blow to your portfolio during turbulent times. For example, when stocks fall during a recession, bonds might rise as investors seek safer havens. This is because bonds are generally considered less risky compared to stocks. They provide fixed interest payments and return the principal amount at maturity, making them a preferred choice during uncertain times. Think of it like building a sturdy house. A well-constructed house relies on a strong foundation and a variety of materials to ensure its stability and durability. Each material has its own strengths and weaknesses, and together they create a structure that can withstand various environmental conditions. You wouldn't want all the support beams made of the same material, susceptible to the same weaknesses. Instead, you would use a combination of wood, steel, and concrete to provide the necessary support and resilience. Similarly, in investing, relying on a single asset class can expose you to significant risks. Diversifying across different asset classes helps to spread and manage these risks effectively. Similarly, your portfolio should be diversified across asset classes like stocks, which offer growth potential, bonds, which provide income and stability, real estate, which can offer both income and appreciation, and commodities, which can act as a hedge against inflation. Bonds, gold, real estate, and commodities. Each of these asset classes has its own set of characteristics and responds differently to various economic factors. For instance, gold is often seen as a safe haven during times of economic uncertainty, while real estate can provide a steady income stream through rental yields. Each asset class responds differently to economic factors like inflation, interest rates, and economic growth. Stocks might perform well during periods of economic expansion, while bonds might be more attractive during times of economic contraction. Commodities can provide a hedge against inflation, and real estate can offer both income and potential appreciation. This diversification helps to mitigate risk. By spreading your investments across different asset classes, you reduce the impact of any single investment's poor performance on your overall portfolio. This balanced approach helps in achieving more stable and consistent returns over time. If one asset class suffers, others can potentially offset the losses, keeping your portfolio afloat. This way, you are not overly reliant on the performance of a single asset class, and your investments are better positioned to navigate through various market conditions. Diversification is not just a strategy, it's a fundamental principle that can help you achieve long-term financial success. The beauty of holding uncorrelated assets lies in their ability to significantly reduce portfolio volatility. When you diversify your investments, you spread your risk across various asset classes, industries, and geographical regions. This means that if one asset underperforms, the others can help cushion the blow, balancing out the overall performance of your portfolio. Diversification is not just about owning a variety of assets, it's about choosing assets that react differently to the same economic events. For instance, when stocks are down, bonds might be up, and vice versa. This counterbalancing effect is what makes diversification so powerful. Studies have shown that a well-diversified portfolio can reduce volatility by as much as 80% compared to a portfolio concentrated in a single asset class. This is because diversified portfolios are less exposed to the risks associated with any single investment. For example, if you only invest in technology stocks, your portfolio is highly susceptible to the ups and downs of the tech industry. However, if you also invest in healthcare, real estate, and international markets, the poor performance of tech stocks can be offset by gains in other sectors. This not only reduces risk, but also provides more stable returns over time. This means smoother returns over the long term and less susceptibility to sudden market swings. Investors who diversify are better positioned to weather economic downturns and market corrections. They can avoid the emotional roller coaster that comes with seeing their portfolio value swing wildly. Instead, they enjoy a more predictable and steady growth trajectory. This is particularly important for long-term goals like retirement, where consistency and reliability are key. By minimizing volatility, Diversification helps investors stay the course and stick to their investment plan, even during turbulent times. Imagine you're on a roller coaster. A concentrated portfolio is like riding without a safety harness, exhilarating at times, terrifying at others. The highs can be incredibly high, but the lows can be devastating. This kind of volatility can lead to panic selling and poor decision-making, which can further harm your financial health. On the other hand, a diversified portfolio acts as a safety harness, providing a sense of security and stability. It allows you to enjoy the ride without the constant fear of a catastrophic drop. A diversified portfolio, with its reduced volatility, is like enjoying the ride with the security of that harness. You still experience the ups and downs of the market, but they are much less extreme. This makes it easier to stay invested and avoid making impulsive decisions based on short-term market movements. Over time, this disciplined approach can lead to better investment outcomes and help you achieve your financial goals. Diversification doesn't eliminate risk entirely, but it does make it more manageable and less stressful. You experience the ups and downs, but with far less intensity. This reduced volatility is particularly beneficial for those who are risk-averse or nearing retirement. It allows them to protect their capital while still participating in market growth. Even for younger investors, diversification provides a solid foundation for building wealth over the long term. By spreading investments across different asset classes, they can take advantage of growth opportunities while mitigating potential losses. This balanced approach is key to achieving financial stability and peace of mind. This stability is crucial for long-term investors who aim to build wealth steadily over time, not gamble on risky market swings. Diversification allows them to focus on their long-term strategy without being derailed by short-term market fluctuations. It provides a buffer against the unpredictable nature of the markets, making it easier to stay committed to their investment plan. In the end, a well-diversified portfolio is not just about reducing risk, it's about creating a smoother, more predictable path to financial success. By minimizing volatility, investors can achieve their financial goals with greater confidence and less stress.